we're going to correlate each of the markets, look at the cross pairs, look at the majors, and we're going to determine what the institutions are doing with price and what they're doing with the overall markets, because there's usually a consensus. You know, gold rallies, dollar drops, euro rallies, and so forth. And so if we can grasp what's taking place on the longer, on the higher time frames on each of the charts, we'll have a much better understanding and a much better perspective of what's taking place currently in the markets. So let's take a look at who we've got in the room with us today. We have Corey. Do you have, Corey is a student. Do you have a microphone there if you want to join in? If you have any questions while we're going through, you could just type yes. Okay, I'll unmute your mic. Corey, you there?
Yes, I am here.
Oh, good stuff. How you doing?
I'm fine. And you?
Good, good. All right. So we got you, and you're able to speak. If you have any questions, you can chime in. If there's anybody else that's wanting to participate, just let me know. Send me a yes, or you could just write, I have a mic and I'm interested in participating. So that way, when we're going through the charts, if you have any basic questions, I won't answer questions specific to our methodology and how we're doing the zones and all that information and all that sort of thing. I'm going to leave that with the students because I'm opening up the doors today for everybody. So everybody can hear me okay? Just let me know if you can hear me okay. Okay, good. All right, good. I'm just gonna save something here. Okay. Okay, so we're going to start by taking a look at gold, because loud and clear, great. So we're going to start by taking a look at gold. This is the chart of gold. We have the monthly here. We have the weekly down here, and we have the daily chart that we're looking here on the main screen. So we know that the force of price is to the upside. So in other words, on the higher time frames, we have institutions accumulating a long position from down here at these lows. Okay, so we're starting to accumulate a long position, which caused price to break through some supply. It came down, came back down, and now we're seeing a push through a monthly area of supply. It took out a couple areas of weekly supply. These were supply zones created by the institutions, and so we know that if the institutions create an area where they are interested in selling, they will typically use those areas to cause price to move lower. Okay, so they'll create a supply zone, and then they'll usually retrace price up into that supply zone to fill in the remaining of their orders to cause price to go downwards. So what if they create a supply zone and price comes up and then they remove that supply zone? Well, if they remove it, then they're obviously not interested in doing this, causing price to go lower. And it's usually because they want price to go higher. So if they're going to remove their supply, what they will create is demand. So that's an area where they have filled in so much demand or so many long orders that's caused price to take out their own supply zone. And then we'll typically see a retracement to that demand zone to cause price to go higher. So that's what we're doing, is we're looking at the charts, we're looking at the supply and demand created by the institutions, and we're trying to determine by the removal of either supply or demand what is likely going to take place. Where are you located, Corey? It sounds like you're in a subway station.
No, I'm outside and I'm in Holland.
Oh, you're in Holland? Oh, beautiful. How's the weather out there?
Very beautiful.
Oh, it is nice and sunny?
Yes, very nice.
Oh, beautiful. Just like here. Nice. Okay, so so what do we have? We have a very clear picture. Cannot hear you properly, Jay. Everybody else can hear me okay? Loud and clear? Jay, you might want to get out of the class and then come back in and check your speakers. getting out and coming back in might reset things, but they might not. Everybody else seems to be hearing okay, so it sounds like it's a local issue. So what we have here is we have a monthly area of supply that the institutions had created, but it has since been removed, meaning that the institutions are likely going to take price higher. And we know by examining the charts that price will have a natural path it wants to take, which will be up to here. 1560s is what we're seeing as the target. So if price wants to come up here, it's going to get up there by the institutions buying. All right. And I'll remind you that, by tracking all the CFTC reports and all the data from the institutions, this is all the data from gold. And we can currently see that you take a look at longs. As of June 25th, longs were at 298,000. Okay, multiply that by whatever you have to multiply that by. But they've got a massive, massive position right now long in gold. So does that mean that they are going to continue pushing price up from these levels? It doesn't necessarily mean that, because this template is color coded, and it's color coded in such a way that it represents when the institutions are aggressive with their position or if they are not aggressive. And right now we can tell by the coloration of this cell, since it is a bright red color, that means they are aggressive. Okay, so we're taking into consideration all the previous positions that the institutions have ever held in gold. And so that we know by them having 298,000 positions long, this is near the highs of the most that they've ever held long. All right. So you have to consider that the institutions, they are working with a certain amount of capital, which means they can only allocate a certain amount of money towards gold and all the other currency pairs. So if they are reaching their maximum size for a long position, you have to take into consideration that they're likely going to take profits on those long positions. Okay, so you can accumulate a long position down here, but when you get up here, if you're already overextended with your long position, you don't have more that you can buy. I mean, there's still room for them to buy. There's definitely a little bit of room for them to continue buying, but you have to take a look at what's the likelihood of them continuing to buy based on them being so overly exposed to the long side right now with their positions. Okay, so you take a look here and you see that they're very overexposed with their long positions at 298. Shorts are pretty much neutral. Okay, they're not very strong, and total size position is pretty aggressive. We're in the dark red category right now, or territory right now, with 359,000. And long exposure, 83% of their overall positions are geared to the long side. So that's, again, you can see the coloration of the cells turning green, which means it's very bullish. And we really have to take into consideration these numbers here, this here, and the fact that they're both aggressive. So after such a big rally like this, what will typically take place when their positions are aggressive is we'll see price decline. Now, why would it decline? Well, if the institutions have so many positions on the long side, when they sell off those positions, it causes price to drop. Okay, just like when they're accumulating a long position, it causes price to increase, and when they sell out of those positions, it causes price to decrease. So if we take a look here at the weekly chart, we can see that they created a demand zone here, price came up, it took out this weekly area of supply, and we haven't had a close above that supply zone, a big tall wick here, and now price is just stalling. All right, so that's what we see on the weekly. When we drop down to the daily, we have to determine what we see. Well, there's a clear picture being shown here. We had a demand zone here. And remember what I was saying. If the institutions are going to cause price to go down, they usually will take out demand zones. If they're going to cause price to go up, they will create a demand zone, retrace that demand area, fill in the rest of those long orders that they have sitting here, and then cause price to go up. Well, what they've done here is they removed that demand zone here. Okay, They removed it, which has created some supply, and it's a tricky situation here to determine where the supply is because it was a gap down. Okay, so essentially that's a bar to the downside. But demand has been removed and supply has been removed. So right now there's no proper structure and there's no demand holding price. The tops, the highs are holding, and we have price stalling right now. So based on what I see on the daily chart, we see no proper structure, but the highs here have not been taken out, and it could very likely be that supply is up here. Okay? It could likely be that supply is up here, and it's holding for now. So based on what we see with the COT report, they're very aggressive with their long position, which indicates that it's very likely that they're going to start taking profits, which is going to cause price to drop. All right. Once price drops over the next couple of reports, we'll see the data. We'll see exactly what they're doing. We'll see that they're starting to close off those long positions and reducing them, thus reducing the aggressiveness of those longs. All right. So it's very easy for them to be so highly aggressive with long positions up here at these highs, take profits on those long positions, causing price to drop. And then when price gets down to this area, which was the last area of demand that they created on the weekly chart, which I would remind you is in an uptrend right now, okay, they could have their long positions not as aggressive. All right, so they can reduce these long positions that they're currently at 298 down to 260, or maybe down to 250, where the levels were at before they started increasing their long positions. So that's what we're watching for right now, because all the evidence is pointing in that direction, that we're going to see a sell-off of long positions, causing price to drop. Right now we have a trend line like this, and this trend line is the trend line that most retail traders are drawing. Okay, so they have the trend upwards on the daily chart, and they're buying here. Price declines right to that test of the trend line. A lot of retail traders are buying here. So isn't that exactly what you would need? Hey, Jason, isn't that exactly what you would need? If the institutions are here with long positions, and they're very aggressive with long positions, if they're going to offload those long positions, what do they need? They need people to come in and buy those positions off of them, right? So how best to get people to come in and buy those long positions off of you than with price declining to an ascending trend line that retail traders are being taught those are good spots to buy. So retail traders come in at the test of that daily trend line, they're buying, and they're buying the positions being offloaded by the the institutions, right? So what are they doing? They're putting their stops down here somewhere. So if price does decline, guess what's going to happen with those stops? Right here. They're going to be triggered, and retail traders going to get out of those long positions here at a loss. Then price is going to drop into an area of demand where the institutions will be buying again. Okay, so this is a likely scenario. I'm not saying this is exactly going to take place, but based on what's taking place with supply and demand on the charts, based on what's taking place with the positions of the institutions, and looking at what zones are being removed and so forth, we can say with a high probability that what's likely going to take place is price is going to drop like this on gold from these highs. Okay, so that's just looking at gold. Okay, we have a lot of evidence to suggest price is going to decline, and we're just looking at gold. So to have a better indication of whether or not gold is going to drop from these highs, we now take a look at the rest of the markets to see if they are showing the same evidence of a similar move that is going to take place in those charts. Everybody with me so far? You guys following me along? Let me just take a sip of my drink here. Good stuff. All right. Okay, so that's what we have taking place with gold. So now we go and take a look at oil. So oil is in a very interesting situation right now because we knew that they were going to start accumulating a long position down here, and they did, because that was an area of demand, and price went up to here, and we knew they were going to take profits at that level by looking at the COT report and understanding the supply and demand by the institutions on all the charts. And so that's exactly what took place. They started taking profits on their long positions. And so going back to here, the COT reports, this is where that started to take place, right here. We've gone from highs of 621,000 long to 496,000. So that's a very dramatic decline, okay? And that is what has fueled this drop here, right through here. But it's an important drop that took place, because this drop not only was fueled by a sell-off of long positions, but it was so powerful, it was strong enough to remove an area of demand that the institutions had. So what did that create? That created supply up here. So now we are in a situation where, let's take a look at the weekly chart for a better view. Price came up. It hit pretty much this area here of supply, where we knew they were going to start taking profits on long positions. Okay, we had an institutional trade signal to go short up here, which worked from here down to here. And so now price is reversing back upwards. And if we take a look here, we can see that as this increase started to happen, we had shorts as price was dropping. And now we have shorts declining from 163,000 down to 118,000. Okay, so remember, when you accumulate a short position, price goes down. When you close a short position, price goes up. That's not reflective for our trading. That's reflective for the institutionals, the institution trades, because they're dealing with such large positions that every time they're getting in and out of a position, they're causing big movements on the charts. And they're doing that. They do it many times on purpose to trick retail traders into luring them into a position. So when you see an increase in price like this moving to the upside, retail traders thinking that we've reached the bottom and now price is going to go up like this, because number one, they're not understanding the grand scheme of what's taking place, that they're just profit taking on long positions, not accumulating a long position. And this move up is not being driven by institutions buying, but by institutions selling. Okay, so it's so key to understand what the institutions are doing and put price in the proper context, so that you don't get into a position when they're getting out of that position. All right, so based on what we're seeing here, the movement of price was profit taking, closing short positions, and up at these highs. What's likely to start happening again or continue happening, because what's been happening here is profit taking. This drive up has been only caused by, can you guys see this chart that I have? Oh, there it goes. Okay, this move up is only caused by short positions closing. So what's likely going to happen up at these highs is a continuation of profit taking on long positions, which is going to cause price to drop, right? So we have a trade signal here to go short that we found based on all this evidence of the likely scenario of this taking place, of oil dropping. And later on, we'll take a look at the US CAD, because as most know, the Canadian dollar and oil pretty much aligned with each other. Okay, if oil gets weak, the Canadian dollar gets weak, and so forth. So, and we can tell here with a quick glance at the US CAD that it's been dropping, meaning it's been getting stronger. And what's been happening with oil? It's been getting stronger. Okay, so we're going to look at the Canadian dollar. We're going to look at the context of where the Canadian dollar is, because we want to see if there's a likelihood of this happening. Because if the US CAD rallies, that means the Canadian dollar is weak, which means likely the oil is going to be getting weak alongside it. Okay, so we'll take a look at that later on. Now let's take a quick look at the dollar. What do we see with the dollar? So on the higher time frames, we know that right here on the monthly chart, okay, price is in consolidation. All right, that's the main thing that you have to remember. Price is in consolidation. So when price is in consolidation, number one, a lot of things can take place. It can go up, it can go down, it can break through zones. It's very difficult to time the markets when price is in consolidation. All right, it's in pretty much no man's land, and I've made mention of this many times where I said, you know, it's like a boat. It's like a boat being stuck in the middle of the sea. When a boat is stuck in the middle of the sea, and there's winds coming from the north, and then sometimes it comes from the south, and sometimes it comes from the east. That boat can go everywhere. But when you're just coming off of the shore and the wind is blowing from the south and you have a map that says you're going to the north and that's the direction that you're pointing your sails is for you to go to the north, then that's the direction you're going to go. And those are the forces of nature that come into play. The wind that blows the sails, and depending on how the wind is hitting those sails, that sailboat is going to go in that direction. Well, the markets is very similar, and you're dealing with forces as well. Although the forces are not wind, the forces are institutional buying and selling, because that's the only thing that moves the markets. Nothing else moves the markets except for the institutions who are buying and selling and causing price to move. The only thing is, for the institutions to make a buck, they need to be offloading their positions to traders who don't understand what's taking place in the markets. So if they're buying something, they need, when they want to get out at the highs, they need somebody to come in and take those positions off of them. Okay, that's the whole reason why the markets exist, is for the big institutions to make money. And they need people to come in and think that it's so easy to trade, and they need them to follow a system that allows the institutions to get out of their positions. So, you know, just like in this situation here, when they're accumulating along here and accumulating along here, they need to take profits here. Well, what sucker is going to be buying gold at highs, right? It's usually the retail, because they need to confirm and confirm multiple times that there is momentum to the upside before they start getting comfortable with buying. But by that time, the institutions are looking to get out. And when the textbooks tell you to buy at a test of a trend line, how convenient does that work for the institutions when they're looking to get out of that long position? All right, so it pretty much works like that. And so when we look at the monthly chart again, we see that, you know, there is no proper formation right now. Okay, the last time it had proper form was here, but that trend line got broken here, and so far it's been in limbo. So what we do know is that on the higher time frames, there is an accumulation of a long position happening from down here. And so when you examine the higher time frames, you know that it's very likely price is going to do this over time. Okay, but remember, we're dealing with a monthly chart. So consider how many candles would have to be created for this to happen. You know, price can come down here before reversing up. Price can stall here and head higher. So this is not something that's going to take place over the span of a few weeks. This is something that's going to take place over a longer period of time. So if you're a positional trader, somebody who has retirement capital to work with, but you want to take safer trades and you're in it for the long term and you just want to make a nice steady return every single year, you can look for these high probability scenarios that you know will take time to play out, but it's something that you can invest your money in and turn around, walk away, and live your life and not have to worry about it. And later on you come and you'll see that it starts to play in your favor. But again, you have to know what's taking place on the higher time frames. So monthly is in limbo, but weekly chart, we have some structure here. But it's been recently broken by this area here. Okay? So When price was coming down to this trend line, that's an area where the retail traders were interested in buying. But they were buying, the institutions pushed it against them, creating some supply. So now we got demand that's been hit, and now we have supply that's just falling short of being hitting. But depending on how you draw that supply, it could likely be in play right now. Okay, so let's take a quick look at the dollar and see what they're doing with their positions. So unlike gold, there's not much being shown here. Okay, they've got a bigger long position than they do with shorts, but looking at the average size of long positions over the last 3 months, it was 42,000. Take a look at longs, it's 34. So we know that long positions are below their average size, and so are shorts. But shorts, if you look at the coloration of the cells, they're neutral, they're blue. So shorts are not very powerful right now. Neither are the long positions. They were aggressive with long positions back here in March. They started to become a little bit more aggressive here, but now that number has since declined since the latest data release from 77% to 74%. So we're not seeing any strong signs of them accumulating a long position at this point. In fact, we're seeing a decline of their overall exposure on the long side. So that combined with them creating a weekly area of supply, which could very likely be used to facilitate a move to the downside like this. Now you can you place what you see here on the dollar chart, and you see what all the evidence and what it's pointing towards, and you match it up with what we're seeing here. Okay, so we're saying that it's likely this is going to drop. All right, now you look at the dollar and we see supply, and it's likely that it's going to drop because of this supply zone. All right, so what does that tell you? Okay, that tells you that if this does drop, there could be this push upwards deep into this weekly area of supply. And then when gold comes down here and they start to reaccumulate and push higher, the dollar can pause and drop like this. Okay? Does that mean the dollar is going to get strong? Well, not in the short term, no. In the short term, no, it's not going to get strong. That's what the evidence is pointing right now. In the long term, yes. But how long is that? We don't know. Because again, we were looking at the monthly chart. You saw how many candles would have to be created for price to move up in that direction. Because remember, in the monthly chart, there is no proper structure telling us that it wants to increase. We don't see on the COT report, we're not seeing an accumulation of a long position, which is getting stronger and stronger. We're seeing that long positions are below their average size. So these are not strong indications that the dollar is going to go up. If the dollar was hitting some major demand that the institutions created, okay, and we saw an increase of long positions slowly being increased, and long positions were above their average size for long positions, then I'd say yes, the dollar is going to get stronger. If it coincided with if we were seeing something in gold pertaining to some weakness, then I would say yes, that's pretty much what I'd expect. But we're not seeing that here. We're seeing something a bit different. We're seeing some weakness in dollar longs. We're seeing the institutions create some supply on the weekly chart. And so all this indicates to us right now, based on the evidence, based on the current market situation right now, what I'm seeing is this. Now that can change, but it's not going to change overnight. Certain things will have to happen on the charts for this dynamic to change. But based on what we're looking at right now, the dynamic of all the zones, where they're located and what's being removed, and the evidence on the COT report, it's likely that we're going to see something like that. So now we go to the Aussie chart. So if the dollar gets weaker, what's likely going to happen with the other currency pairs? Well, it's likely that's going to go up, and we've been expecting that on the Aussie, okay? Because again, on the Aussie, we see something really interesting here. We saw, excuse me, we saw that they are very aggressive with their short positions here, 108,000. Look at the coloration of that sell. Look how strong in red it was. So when it was here, we knew that they were going to be taking profits on those short positions. And we said it's going to cause price to rally. When they're getting out of short positions, it causes price to rally. So that is exactly what has been taking place since here, is that rally that we were expecting. Okay. So they created demand, price dropped into that demand. We got that push to the upside. And so now it's kind of stalling here at this weekly descending 20 EMA. All right. So what's going to take place? Well, we also have that monthly descending trend line that's being hit right now. But is it likely price is going to move up even higher? It's likely. Okay. It's difficult to say because they're in the process of profit taking. They're not accumulating a position. Remember, when the institutions come in and they're interested in accumulating a position, the force that they bring into the markets is very strong. So that drives the market. That drives and propels price in a specific direction. When they come in and they're taking profits, but they have expectations of moving price in a continued move to the downside, like we are expecting with the Aussie, okay? When examining the higher time frames on the Aussie, we know that the higher time frame forces are pushing price down, which means on a long-term scale, they're looking to accumulate a short position and cause price to drop, okay? Just like on the longer time frame, they're looking to accumulate a bigger long position to cause price to go up. So just like we have multiple time frames that we're looking at, the institutions have multiple time frames that they open positions with. Okay, they open positions for day trades. They open positions to hold for on a weekly basis, on a monthly basis, on a yearly basis, and multiple years. So you can imagine if they open up a position and it causes price to move, how big of a position can they open at the lows of price to cause it to for a ride up a lot higher? They can't just come in and buy, billions of dollars of long contracts to cause price to accumulate a long position, because if they did that, price would just rally up so hard that they would be forced to buy here, 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 and that defeats the whole purpose of them trying to accumulate a long position at lows to get out here. Like for instance, let's take a quick look here at the Aussie monthly chart. Okay, let me just erase those drawings. Okay, okay. So based on looking at the Aussie chart, we know that price is likely going to decline, and they knew that since up here. But if they wanted to accumulate a massive position to hold for multiple months and a couple years, they wouldn't just accumulate that position in one shot or in 1 month. Because if they did that, what you would see on the charts is just this, okay? Because they wouldn't have enough people selling those short positions to them, okay? They have to spend months to get retail traders to be taking the opposite side of those positions. So if they're selling, if they're opening up short positions, they need retail traders to be closing short positions. Okay. So that takes a long time to accumulate. They have to do a lot of things on the on the lower time frames to help lure the retail traders into making those decisions. So on the higher time frame, we know that it's likely that price is going to drop. When price is at the lows here and they're already very aggressive with their short positions, they can't add more short. They're already very short. So they don't just add more short positions when they're very, very aggressive with their shorts. What they do is they have to offload them, take profits, which is going to cause price to move up. But because they're taking profits on short positions and not accumulating, which is going back to the point that I was making before, it's difficult to time exactly where they're going to stop taking profits on short positions and where they're going to start pushing price back to the downside. Okay, so when we say it's likely price is going to go up, we're basing it on how aggressive they were with their short positions and what is likely going to take place with the other markets, such as the dollar and gold. Okay, so again, we look here and we can see that the likelihood is that gold is going to drop here. All right, so if gold drops, we're expecting some kind of a movement down like this on the Aussie, because again, Aussie's kind of correlated with gold. All right, so they don't move perfectly together, but you can basically look at the two and see that they are somewhat moving alongside each other. Let's see, would you say that is a double bottom situation? These two? Yeah, I guess so. Retail traders would call it a double bottom. Supply and demand traders would understand that it was basically a retest of an area where the institutions had a demand zone. Okay, and if you take a look here, that first bottom was somewhere around here, aggressive with shorts. Price jumped up, they accumulated more shorts, and then started taking profits. So retail traders look at this as a double bottom, but basically it was two tests of a demand zone here. Okay, if this double bottom was not taking place in a demand zone, then it wouldn't be a double bottom, it would just continue lower. So that's what makes looking for double bottoms very it's not a good strategy for trading. Okay, that's why a lot of traders lose money, is because they're looking for patterns. And if you don't know the context in which those patterns are taking place, you're basically you're basically trading without enough information to make good trading decisions. So, but yeah, retail traders would call this a double bottom. We don't look at it that way. We look at it what's really taking place by looking at the supply and demand. So somebody has a comment. I'll read it while I take a drink. Yes, retail trade. The only, like, when you understand that the markets don't exist for retail traders to make money, okay? That's not why the market exists. The market exists for many purposes. Number one, it exists so that corporations can exchange money from one to another. And for a long time, it was only big institutions that were capable of doing this. But it's like the mafia, okay? A long time ago, the Italian mafia used to work against each other. They used to kill each other. They used to do crimes against each other, used to move into each other's territories. And then one day they got together and they were a little bit smart. And they said, listen, instead of us fighting against each other, why don't we work peacefully together? And we'll take advantage of everybody else. Instead of taking advantage of each other and, you know, working against each other, why don't we work smarter? We work alongside each other, and we'll all prosper by using everybody else, by extorting money from other people and all that sort of stuff. So the markets are the exact same way, okay? The institutions, if you want to look at them as mafia, you can. But when the currency markets were only for the institutions, they were working against each other, okay? Because they were exchanging money and taking positions, and the only people that were moving the markets were them. So when they said, no, we want the average person who's sitting at home with a bank account that they work so hard to fill, okay? Let's get them access to be involved in these markets. That way, if we want to accumulate a position, we could be accumulating a position that they are offloading to us, okay? But then they said, okay, but if everybody's trading differently in different styles, how are we going to manage to accumulate a long position at the lows when people should have enough brains to know that you wouldn't want to buy a car at a high price if you were thinking about selling it, If you wanted to buy a car and make money by selling it, you'd want to get as cheap a deal as possible and then sell it to somebody else for more money. So how are we going to trick people into buying something at expensive prices when we're selling it to them? And the answer was, well, if we can trick them into thinking that that expensive price that they're buying it at is not that expensive because it's actually going to be worth a lot more money, then we can offload our positions to them when we wanted to take profits. So then they thought, well, how are we going to do that? Well, if there was a book, how did they teach us everything else in life? How did they teach us about the history of the world? Through textbooks in school. How do they teach you about economics? Through textbooks in school. How do they teach you about geography and astrology and everything else about the world? Through textbooks at school. So why would trading be any different? Well, trading isn't different. It's the exact same thing. So you scour through the internet, what do you see? The vast majority of material, the educational material on how to trade, what are they teaching you? Draw the trend line. It's all the same stuff, okay? Patterns, double bottoms, haramis, dojis, triple tops, divergences. It's all things to take your mind off of what's truly taking place in the markets. And so all these algorithms that the institutions are using, they're trying to find locations on the charts that retail traders are going to be suckered into buying or selling. Okay, so they're coming into the market. If they want to buy down here at the lows, they're going to have to sucker people into selling at these lows. Okay, like when price comes up to this trend line, you look at books about trend lines, draw a trend line connecting the peaks, and then when price comes up and hits that trend line, you sell. Well, they sell and then they break that, and they cause price to go up to the upside. So this is how it works. When you start understanding how the markets actually work, and you stop looking at regular technical analysis and their support and resistance and all these patterns and stuff, and you start focusing on what's really taking place, then you can trade alongside the institutions. Once you know the game and you know what they're doing and how they're playing it, it becomes very, I shouldn't say easy, because it's not easy. Tracking what they do requires a lot of knowledge of what's taking place, and there's a bunch of skills that you have to acquire to be able to do this. But once you do it long enough, you start to understand what's truly taking place, and then you can time your entries and your exits based on what the institutions are doing. And then it becomes simple. Trading becomes simple because you're just doing what the banks are doing. Okay. So I got a quick question here. How important are the commercial? What happens when non-commercial don't make big moves, but commercial make a big move? Like the Japanese yen last week, shorts went 26 to the upside. Okay, good question. So let's take a look at the Japanese yen. Commercials. They went from 112,000 down to 45, down to 65. Is that what you're talking about? Shorts went from 26% up on their side. So they declined their short positions. Okay, so basically how it works is commercial traders, and I know a lot of people have asked me about this, what's more important, following commercials or non-commercial? The bottom line is non-commercials are more important, not commercial. Okay, commercials are usually hedging real positions that they have in the markets, like real oil. So they're hedging because they want to maintain the value of what they own at the same amount. So how do you maintain the value of oil always at $50 a barrel? If you actually have oil and you want to maintain that value at $50, if price of oil goes up, you're not maintaining it at 50 because it's going up to 60. So how do you maintain it? Well, you short oil at 50. So if the value goes up, the value of your real oil goes up, but you're maintaining the value of 50 by your position in the market going down. That's what commercial traders do. Non-commercial are traders who are trying to speculate and make money by the moves going up and down. So they are the more important ones. Can we gather information by looking at non-commercial? Yes, we can. Why would the non-commercials be reducing their short positions? Well, I'll leave that for you to think about. Okay, so let's move on because we're running out of time here. So the Aussie, we are expecting it to continue moving higher based on what we're seeing with the other with the dollar and gold. So let's take a look at the Aussie CAD. Well, we don't have time to go through all the cross pairs right now, so we'll continue with the majors. So just like on the dollar, okay, just like on the dollar, remember when we saw the dollar here, they shifted momentum creating supply, which leads us to believe that the dollar is going to drop. How far, we don't know, but the evidence supports a possible move to the downside. What we have with the euro is them creating an area of demand, okay? The break of that trend line. This is significant. So we take a look at the euro, and we can see that long positions are above average size, so that's decent, and short positions are below average size. So if you are going to shift momentum, right, if you're accumulating a big position to the upside and your position continues to be above your average size, that means that momentum to the upside is strong. You're buying, you're accumulating, you're driven to push it up. And because you're the only one moving the markets to the upside, okay, you and all the other big players, that is significant. And that means price is going to move up. But once the momentum shifts, what will take place is chart formations, demand zones being removed, supply zones being created, and positions being lower than average size. So we're seeing that here. Longs are above, so it shows momentum shifting to the upside, and short positions are below, which means they're not so heavily focused on their short positions anymore. And we know that they've been very aggressive with their short positions all throughout here. And total size, very aggressive. So what does that tell you? Remember what we were looking at earlier in this session? When they're aggressive with positions, what do? They take profits, which causes price to move in the opposite directions. So we've seen that momentum shift here on the charts by this trend line holding a descending structure to the downside, breaking, creating demand. Okay? So when price rallies and comes down to that demand, what's likely going to happen? Based on the evidence, based on the COT reports, based on what we're seeing with everything else, it's likely that that's going to happen. Okay? Up. All right? What did I say with gold? Up. What did I say with the dollar? Down. So you see how the evidence, you collect the evidence for gold, you collect the evidence for oil, you collect evidence for the dollar, the Aussie, the euro, and you can start to see a pattern being formed. You can start to see that all this evidence put together is starting to present a very clear picture of what is likely going to happen, okay? So, again, we're not seeing a lot of an accumulation of a position, because when we start to see an accumulation of a position, we can say with a high degree of certainty where price is going to move. We're not seeing accumulations of positions. We're seeing profit taking. So again, when profit taking is taking place, it makes things a bit more tricky to be able to judge exactly where price is going to go, but it's likely that price is going to be making a move to the upside like this in this week and the coming weeks. Okay? So knowing this, if we know that it's likely going to move up, you can look at euro cross pairs and you basically match it up with what pairs are going to be weak, okay? What currencies are going to be weak based on the evidence, based on what we're seeing on the charts for the Aussie US dollar, the euro US dollar, the pound US dollar, the Kiwi dollar, the US Swiss franc, US Japanese yen, and the US CAD. We look at those charts, we see what's likely going to happen. Are those currencies going to get weak or strong? So we look here at the euro, we see the likelihood of the euro getting stronger. So if we know that the likelihood of the euro is going to get stronger, we can then look at the euro cross pairs and we can see which charts present a good opportunity to go long. Is there any demand zones that price are coming into on the Euro Aussie, Euro CAD, Euro Pound, Euro Yen? Okay. And if they are coming into demand, there's your signal. There's your signal to buy. Okay. So that's how we put all this together, is accumulating the evidence, putting it together to see what's likely going to happen with each currency pair, and then looking at the cross pairs to see if there's any institutional zones that have been recently created that will help facilitate a move that we are expecting is going to take place. So that is that. Now we look at the pound. So looking at the pound, we see that price is in an area of demand, and we know that price has shifted momentum to the upside, and we know that we have some demand here, and what's likely going to take place is a push to the upside. So this is also in correlation with what we've been seeing with the other ones. We look at the COT data, what do we see? Well, we see that the short positions were aggressive right here. Aggressive here, they took profits, it caused price to move up. And aggressive again. Just recently, a couple weeks ago, total size was very aggressive. So they need to take profit on short positions. Now you think to yourself, is this something that we've seen before in this market analysis? Is there anywhere where we've seen them being aggressive with the position, so much so that they need to start taking profits, which is going to cause price to move in the opposing direction of that position? The answer is yes, we've seen that. So is this not correlated with what we're seeing, right? We're pretty much detectives, okay? We're detectives, and the markets are the cases that we have to examine and look for evidence. So we come to the scene. We have our we have all these people that have witnessed, that were in the room at the time of the mysterious murder. Was it the butler? Was it the chef? Was it this person or that? And what do? We have to go to each person and ask them questions. Were you here in the room? What time did you leave? What were you doing? And we accumulate the evidence. And then we go to the next person. What were you doing here? Why are you here? Did you know that person? Did you leave the room? And then the more people you speak to, the more evidence you gather, you start to see what the bigger truth is. Because everybody's going to have their own agenda. Everybody's going to try to throw you off, maybe because they seem a little bit guilty, or it looks like they could possibly have caused the murder, so they don't want you to suspect that they are them, so they're going to make up some stories and tell you that they weren't in the room at that time. It works like this. So we have to examine the markets, look for the evidence, and the more evidence we collect, the more information we have, and then we're better prepared to take advantage of those moves. And when you examine the markets like this, which is the way that the institutions do not want you to do it, then the likelihood of you being successful in your trades skyrockets. Okay? Does it require a lot of work? Yes, it does. We have to collect the data. We have to collect the information on the charts. We have to track the supply and demand zones of the institutions. And that's what we do here at the school. This is what we do. This is what's contained in the Arujo report that gets sent out every weekend. We examine the COT report, the data, we plot it out in this spreadsheet, and then we take a look and we do the analysis. What's taking place? Why are they accumulating a position? What's likely going to happen? Are they going to be taking profits? How is that going to affect the markets? So this is what we do. This is how we put it all together. So it's likely it's going to go up. That is aligned with the Aussie. That's aligned somewhat with the Euro. Okay. It's also very much aligned with gold, what we see with gold. So we go to the US CAD, it's dropping. Is it likely it's going to go up? Well, it's sitting within demand right now. Okay, so yes, it's likely it's going to go up. And we look at the US dollar, Japanese yen. Is it likely it's going to go up right now? Yes, it's likely it's going to go up right now because institutions have demand here. Likely it's going to go up. Longer term, down. Okay. Kiwi, we knew it was going to go up. Why? Well, just like with the Aussie, Let's take a quick look here. Let's go to the Kiwi. What do we have here? Aggressive with short positions. When they were aggressive with short positions, they have to take profits. When you close short positions, it causes price to go up. And that's what took place right inside of a demand zone by the institutions that were created by the institutions. So price rallied up, just like with the Aussie, just like with the pound, same thing. Last but not least, the Swiss. Price already shifted momentum, causing price to drop. We were expecting this drop because they were, again, very aggressive with long positions. Right here. Very aggressive with long positions. There's nowhere to go. You can't keep adding long, so you have to take profits. That's back in April. Okay? And let's go to the daily chart. April is right at the highs. You see what I'm saying? Right at the highs. And then price drops. Okay? So, so that's it. That's all the major pairs. We didn't have time to go into detail with all the cross pairs, but this gives you a good idea of what's taking place now in the markets. Okay. We have some questions. Like I mentioned that we had some new people in here that wanted to ask some questions, so I'll go through them one by one. Okay. Juan writes, but they know supply and demand areas too. Are you talking about they being the institutions? They know supply and demand. They know supply because they're creating the supply and demand. Okay. They can't hide the supply and demand zones. If you know how to look for them, they can't hide them because they're creating it. They need to fill in orders to move the markets. They're looking to profit from the markets moving up and down. So they are the ones creating it. Are they preparing for Japanese yen going long? No, they're preparing to cause it to drop. Okay, for the yen to get stronger over time. Paul writes, "Hi, thank you so much for this supportive education." My pleasure, Paul. My pleasure. The more people we can reach out to educate them on what's really taking place, the better. Jason writes, "Hi Kevin, I have some questions about enrollment. Would you be able to address after?" Sure. You can. Well, if you have certain questions, you can email me and I'll get back to you. Okay. Paul, based on the COT report, which data is very useful, commercial, non-commercial? Okay. Well, I addressed that, right, Paul? I think you now know. Commercial and non-commercial, it has been a challenge for me. No problem. I think we answered that, and I'm glad to be of help. Miguel, that drop to that daily demand zone, is it a valid trade? It is a valid trade, isn't it? Which pair was that, Miguel? Let me know. On pound US dollar daily. Drop from supply here. There was a drop from supply. No, I wouldn't have trade that. I wouldn't have trade. It could have been. You could have shorted that on a lower time frame for a day trade, for sure, just to get in for a small drop. That worked out very well. The initial move was here though. This was the move. This would have been the move to take advantage of. Okay. And just like on the lower time frames, taking advantage of a move to the upside will be possible in the next few days. Corey, what will the euro pound do then? What will the euro pound? The euro pound's been a big mess. It's difficult to say because again, it's the phase of the market right now. They're taking profits, so we can't really judge exactly what the euro and the pound is going to do and what moves they're going to do. When they start after the profit taking and then they start to reaccumulate, that's when we can judge exactly what is likely going to take place with the euro pound, because then we know what forces are coming into the market. You know, it's them accumulating a position, so we know where they're going to push it, and then we can better determine what is going to happen with those other with that pair.
Okay, thank you.
Yeah, no problem. If pound expect to go up, why the commercial have such big position in long? Okay. Why do they have such a big position in long? Commercial have a position in long. They don't have. We're not following commercial. Remember, commercial takes the opposite side. So if they have a big position in long, that means it's going to drop. Okay. Remember, they're just whoever is commercial who's opening up a long position in pound is because they expect the pound to drop and become weaker. Okay, so they're not trying to make money with the pound getting weaker. They're trying to stabilize the price of the pound for their own purposes. That's how you have to look at it. So this becoming stronger is telling me that it's going to drop. Just like the commercials who are actually betting on the direction of price, they're very short. Okay, that's how you have to look at it. When you collect data, do you manually collect them or have you automated the data collection? Nothing that I do is automated. Everything I do is manual. I have not come across a way to import the data from their website into my spreadsheets automatically. And plus, even if I did, I probably wouldn't trust it because I don't like relying on anything to do things for me automatically. I have a routine that I go through and I enjoy it, and I like to actually go to the website every single week, look at the data, and copy it into my spreadsheet manually. It's just what I like to do, and I've never found an automatic way to do it. So, well, after the drop from broken downtrend. After the drop from the broken downtrend, ooh, 1258. Miguel, let me put you, can I unmute you, Miguel? Is that cool? Miguel, are you there? Do you have a microphone? Hello, Miguel? Nope, not there. Sorry, Miguel, I'm not sure what you're mentioning there. Jason, okay, Kevin, what email address can I use? Can I call you on WhatsApp or something, or strictly email? All right, so if you go to the website, whiteoakfx.com, you will see that if under contact at the top, you'll get my email address right here. Okay, whiteoakcapital@outlook.com. You can click that email and send me an email. And if you have a ton of questions that's going to take too long to ask in an email, what we can do is we can create, well, what's your question? Is it just one question that you have? If it's just one question, you can just ask me now and I'll answer it for you. Okay, Kevin, thank you. Valentin. Juan, great. Kevin, great material. I really like the way you see the market. Kudos. Thank you, sir. Miguel, Banda, no mic. Jason Miguel. What service do you offer for training? Okay, well, really quickly, I'll go through this and then I'll leave you for the rest of the day. What do we offer here at the school? Well, what we offer is an education on how the markets actually work. Okay, we basically help you retrain your mind to look at the markets in a completely different way. We're not here to say these are the rules and you must follow these very simple rules and then you'll be profitable, because following rules is not what's going to make you profitable. Following a very specific system is not going to make you profitable. It can make you some profits for a short period of time, but then when the market dynamics change, then the system doesn't work. So understanding the markets, you need to first understand how it really works. You need to know how to find the institution's supply and demand zones. You need to know which trend lines to draw on the charts, which will be the trend lines that the institutions have on their charts as well, and how to locate their zones. Once you understand where their zones are located, then you can slowly take that information and start to build evidence towards what is likely going to take place with the markets. So we have video lessons. We have 3 levels at the school. When you become a member and a student at the school, you start at level 1. And the information that we provide you in level 1 is the basic information: how to find the zones, how to draw the trend lines, how the COT report works, the Arujo report, how we put the data together, gives you all the basic. Once you go through those video lessons, you take notes, you learn, you record this information to your mind, and then we have classroom sessions, okay? And in the classroom sessions, you can participate. In the classroom sessions, we go over a specific chart, you connect with it, you connect with the classroom, you go through a specific chart, we plot the supply and demand together, and then I give you homework. I give you a section of that chart and I say, okay, you've gone through the video lessons, you know what to look for, you know how to do it, now do it. So you go through it, you plot the supply and demand, and then you email me the chart, and the next week class, we review it. So now you start to see what you did right, what you did wrong, and you start building your skill set, okay? You start building your skill set on how supply and demand has to be drawn, how the trend lines have to be drawn. That's where we start you off at. And after you've taken enough classes, you'll have a pretty good idea of how to locate the zones and the trend lines. And it all depends on how much work and effort you put into it. I mean, we have a student that's been with us for about 4 months, and he was just in the class that we had earlier today, and he's doing excellent. He's doing an amazing job. He's finding the vast majority of the zones and the trend lines, and he's really starting to understand how the market actually moves. So it takes time. It's not going to be something that's going to happen overnight, because number one, if you're new to trading, this is going to be like learning a brand new language. And number two, if you've been trading for some time but you've been just educated with the wrong information, you're going to have to retrain your brain on how to actually the right approach, in my opinion, the right approach to how to trade the markets. So that takes time. That takes repetition. It takes you constantly doing it over and over again until your mind understands how it works. And then when you get to that level, then you can start understanding multiple time frames, okay? How price reacts from monthly zones, weekly zones, and daily zones, and how all is combined together to present a story. Okay, once you follow the story, then you know where it's heading towards, and then you can trade alongside the institutions. So we have the classroom sessions that we do, and so we just started a new classroom session that started, when was it, July 2nd. So July 2nd, we just started a new classroom session for the Aussie US dollar daily chart, and we're going to have 9 sessions. So every week we have 9 sessions, or every week we have a session, and it'll be all throughout July and August, a combination of 9 classes. So we just started one, so the new members that have signed up, they're lucky that they just recently signed up, because we've just started. So they can go through our archives and watch the classroom session that we recorded and placed in the archive, so the students can have access to it. You can watch it. The first session that we did, we plotted all the supply and demand zones on the chart, so you can do the same thing with your charts. We also show you how to use TradingView, because that's what we're using to do all of our charting. We have video lessons on that, how to use it, how to install the proper indicators that will help you to locate the zones. And then once you get yourself up to date with the classes that we've done, again, we've only done one for the Aussie chart. Once you plot the zones and you do the homework, next Tuesday when we do our second class, you'll be up to speed with where we left off, and then you'll be ready to participate and submit your charts for review in the class. So we do this every week. We're constantly doing classrooms. We're constantly working on building your skills, and we do this, you know, and it really does require your involvement. It's like anything. If you think you're just going to watch a few videos and learn some lessons and then apply some, you know, a handful of rules to understand how the markets really work, this is not how that works. Okay, we're trying to give you an education that will last you a lifetime, not a strategy that's going to maybe last 2-3 years and then fail you because the market dynamics change. Because after 2-3 years, what have you learned about the markets? Nothing. You've learned that your strategy doesn't work. You may learn a few things about the markets because of your experience, but because you are not focusing on understanding the markets for how it truly is working, 2-3 years from now, you could be, in the same spot that you are today. What we're focusing on is learning how the markets really work. So I can tell you, if you work hard in 2-3 years, the amount of knowledge that you're going to accumulate is going to be exponential, because you're focusing on the real information, on good education, okay, on what you should really be focusing on, not, what retail traders are doing. So that's our system here. That's how we help students, is through these classroom sessions, through the video lessons, through being engaged. We have a forum where we post charts, updated charts of all the supply and demand zones of the institutions, so you can keep up to date with your own charts and explanations on why they're creating the zones. So all this helps you to immerse yourself into the understanding of how the markets truly work. And it's only a matter of time until you pick it up, and then you get comfortable enough to start taking trades on your own, and away you go for the rest of your life, as long as you work towards it. Okay, so we went well over our 1 hour. I hope this session was useful to you. Again, you have my email address. If you have any further questions, shoot me an email. I'll be happy to answer you. And that's it. So you guys now have a good understanding of what's taking place in the markets. Keep your eye on what takes place. You heard the key points that I mentioned throughout this session. So keep an eye on the markets and see for yourself if what we've discussed here today is actually going to play out. All right. Thanks, everybody, for joining me today. It was really nice seeing some new faces in here. And we'll talk to you soon. Thanks very much.